Welcome back. Today we are comparing and contrasting taking the standard deduction versus itemizing. I have noticed that taxpayers don't always know if they are allowed to take both deductions, what the deductions are, and if records and documentations are needed no matter what deduction they take. Do take note that all the information in this webinar is already updated for the effect of the tax reform. If you would like to know all the details of how the tax reform affected itemized deductions, it will be addressed in a separate video, so be on the lookout for that. So let's dive right in. Standard deduction is a specific dollar amount that reduces income on which the taxpayer is taxed and varies according to the filing status. There is also an additional standard deduction for individuals who are blind, disabled, or age 65 and over. A taxpayer cannot take the standard deduction if they are itemizing deductions. In addition, certain individuals cannot take a standard deduction or can only take a reduced deduction. For those special rules, refer to the article in the description. Itemized deductions are expenses such as medical, dental, and amounts paid for certain taxes, home indebtedness, charitable contributions. You can also deduct certain casualty and theft losses. An itemized deduction is claimed through filing Schedule A on the Taxpayers 1040. Just like for standard deductions, itemized deductions have special rules for certain individuals. For example, married taxpayers filing a separate return. So if you find yourself in that category, refer to the article for the publication applicable to you. Note, don't include expenses on Schedule A that have been deducted anywhere else on a tax return, or have been paid or reimbursed to you by your employer, insurance, or medical coverage. Each of the allowable Schedule A deductions have their own rules to be considered qualified. Have records available, limits that they cannot exceed, and amounts that they must exceed to be deductible. In summary, a taxpayer federal income will be less if they take the greater of their itemized deduction or their standard deduction. A taxpayer may take one or the other, but may not take both. To claim a standard deduction, records are not required. On the other hand, records are required or need to be available upon request to allow itemized deductions. Also, do talk to your tax accountant to figure out if it's even worth for you to keep track and retain records of the allowable itemized deductions. Since standard deductions have doubled due to the tax reform, and itemized deductions only start benefiting you when they exceed your standard deduction. Refer to the article in the description to the video for standard deduction amounts that now serve as a threshold that itemized deduction must beat to benefit you. That is it for today. Until next time. Ooh.